Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today's Friday. It's September 30th. The month is almost over, and hurricane is behind us. Folks, I want to thank each and every one of you for sending me some wonderful comments, emails, and letters of support yesterday through the hurricane. Everybody's great. Nobody's hurt. Everybody at the Wealth Press team is good. The only person who may be in the line of fire was Jack Carter, because he's in the Naples, about 50 miles from Fort Myers area. But he's okay. Everybody's healthy. Everybody's good. Nobody is damaged. And again, I want to thank you for all the wonderful letters, comments, and feedback from you guys. You guys are amazing. Now, I want you guys to do something for me. If you guys are getting a benefit out of these videos, comment below this video. I really would appreciate it. It helps the interaction. When people see interaction, it makes the videos more watchable, and I love that because I put everything into them. So, as you can see here, the market is opening a little higher. Most of the downside and most of the pressure that we've been seeing from the stock market in the last 10 days is not being driven by U.S. stocks. It's being driven by global economy, and I'll explain why. But in a nutshell, what you're seeing right now is you're seeing the bond market, again, correlate very, very strongly. See this? This is the bond market. Look at the Dow. They look almost identical. They look almost identical. And notice the bond market and the Dow broke, but it looks like the bond market has had it, and it looks like the bond market's a little undervalued right now in the short term. So I'm expecting a bounce to the upside. Also, GDP yesterday was in line, and personal consumption was above estimates. That's a very, 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 very strong and powerful sign that things are not as bad as we expect. This was undercut by global data, which I'll talk about in a minute. But overall, things were not as bad. And again, I've been noticing U.S. stocks firm up towards the end of the day and then taken down in the morning by global economy. Now, the U.S. market has already seen it. It's already felt its way, or has assimilated global economy, U.S. economy, I think right around here. This is it assimilating global economy. So let me show you this using the Dow. If you look at the Dow, you will see that we bottomed here, then we went up, and then we kind of bottomed, and then we broke lower. I think the worst case for the U.S. was right here, and this is now assimilating global economy, which I'll talk about next. But remember, the world is one, and I'm noticing the U.S. stocks are not being pulled by their own weight. They're actually being pulled by global stocks, and that's actually a positive sign, because typically global recessions work their way through the biggest economy, then they work through the smaller economies, and then things turn around. And again, I'm very encouraged by the 2% personal expenditures. Now let's talk a little bit about global economy so you guys can see what's been knocking us down really, really hard the last couple of weeks. Global stocks were mixed Friday after inflation in 19 countries that use the euro spiked to a record, and Chinese factory activity weakened. Inflation in Germany, France, and other Eurozone countries accelerated to 10% in Europe from 9.1%. That's what's really causing this downside. That was the highest record since 1997. So you guys can understand, when I say we're in a really crazy time right now, maybe a time we've been 10 times in history before, this should highlight it, the highest record for the euro since 1997. I mean, we're talking many, many years. Stock market and the value of the British pound that rebound after the Bank of England said it would buy government bonds, something that a lot of other banks will be doing if this continues, to support their price. They intervened. That's also a very, very powerful sign. But the markets resumed their slide Thursday after Truss shrugged off criticism and defended her tax cut plan despite a plea from the International Fund to reverse course. That was a big mistake. The yield on the 2-year Treasury note widened 4.2 on Thursday from Wednesday. That's very, very wide. And China, and again, this is one of the reasons why we've been seeing downside. Survey of manufacturing business activity, official industry found production declined. Export orders declined. What do you think China makes their money from? Exports. And that was in line with expectations that a China manufacturing boom would fade due to weak global demand. So that's the biggest reason why we've been going down. Not because of U.S. economy, because of global economy. Now, volatility, as you can see here, via the VIX, every time we're in this area, we tend to spike out, and this time doesn't appear to be any difference. It appears that the worst on this round is behind us. Also, if you look at momentum levels, and I always look at the number of stocks making 20-day highs and lows. Look at this number. Keep your eye on this number right here, right? 286, right? Look at it yesterday, 13, right? Look at it day before, 426, 770, 759. Look at this number, 9, 17, 27, 24, 27, 20. You guys see what I'm saying here? But now, if we go to today, that number is actually only 286.13. So this is about a quarter of what it was a few days back, which means there's not significant breakdowns happening to the downside. Also, aside from the volatility, if you look at momentum levels, which we will look at right now, if you look at the number of stocks in the 50-day, in the S&P, I mean, look at that. This is let me show you 20 years. Look at 2 years. I mean, we have not been here since this is earlier this year. I mean, hardly ever we go here. And then whenever we do, we tend to spike back up. We're in that level. And on a 20-year basis, whew, it's bad. Now, look at the NASDAQ. Look at the NASDAQ. NASDAQ 200-day moving average. I mean, this thing is, when I say we're really down, we're really down. I've been getting a lot of calls from people saying, Roger, should I be liquidating my stocks? I want you guys to understand where I'm coming from. Right now, we're in a very, 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 very vulnerable position. So if you have stocks or options that have some time value, I would hold on to them because the odds are, and I mean, when I say the odds are, we're going to go higher and we're going to reverse, and the market will bounce from these levels. We're not going to stay at these levels. So I know that you've been hearing from some analysts talking about the Dow taking another leg down. Well, that may happen, but the odds are, before it happens, the Dow hits the 200-day moving average, and so does the bond market. So from where I'm sitting, I think we're going to go higher and then possibly go lower. That will have to be a wait-and-see analysis. We won't know that. We're not going to know that for at least another couple of months. We need to see what the Fed will do. But in the short term, we are, in fact, just sinking and sinking and sinking. Now, if you look at the type of stocks that are looking to go higher right now, you will see energy, healthcare, financial, and you will notice that communications, information technology, consumer discretionary is in fact starting to come down. I'm expecting more of this. I'm expecting the spec stocks to continue moving lower and the non-speculative stocks to stay higher. Also, I think it's really important to notice something key here. Take a look at this. This is ARK. This is Kathy Woods. I want you guys to see this. She peaked out 11/21, beginning of November 21. The S&P peaked out January 22. Small caps peaked out almost a year earlier. And look, they are not going down like the rest of the market right now. They did not break the low. See, they're still in that range on the downside, but look at the Dow. So that's telling me that small caps are starting to assimilate strength. And as I mentioned right here, if you look at the Russell 2000 number of stocks, look, 10%, 5%, 18%, 12%. It's still leading, which leads me to believe that small caps are starting to gain strength. And if the global economy is assimilating a recession, then we should start seeing upside in America, because America is the strongest economy. It goes down first and it comes up first. Now, folks, I want you to know that tomorrow I'm going to do a weekend market analysis update at noon, high noon. If you're in Los Angeles or Pacific time, it's happening at 9 a.m. But if you're on the East Coast, it's happening at noon. Now, we're in a difficult market. So I'm going to help folks navigate their way through. I'll tell you what my algos are showing. I'll talk about the put-to-call ratio, which is at the lowest level we've seen since 2008. You got to see this with your own eyes. This is amazing. I mean, look at this thing. So put-to-call ratio, 2008 level. Stock have lost 2 years of gains. Interest rates are rising. Inflation is not under control, all while international bonds currencies are collapsing. And honestly, next week could be crazy. I'm doing a live market session. I'll answer all your questions at high noon tomorrow Eastern time, noon. During this critical session, I'll cover what stocks to look at next week, where I believe the market's heading, and my number one way to prepare for what's coming. Noon tomorrow. And I want to thank you for all the nice feedback, all the nice letters, and post comments below this video. It drives viewership, and I get to answer your question, and I get to see what you guys want me to answer. So post comments below this video or send me email support@marketgeeks.com. Bye. Have a great weekend, and I'll see you tomorrow at high noon. Bye.